With the bear market holding on for dear life and perhaps even deepening, some investors are getting wrecked because of 7 things they're doing. Holy banana bread, let's talk about this. It is much easier to invest in a bull market because for the most part, prices are going up and it's harder to find losing opportunities. These easy wins can bolster new investor confidence, which makes it easier for them to take on more risk than they probably should. The rewards from that extra risk are good, and that only reinforces new investors to take on more and more risk. In addition, the overall bull market has lower amounts of volatility, which makes it much easier to hold the course with your investments. There is also high liquidity, which makes it easier to sell, and it helps keep the prices, well, a little bit on the higher side. Unfortunately, bull markets can't last forever, and bear markets are a completely different story when it comes to investing. In fact, the confidence from the bull market and its associated effects can make it easy for the bear market to absolutely mangle investors, especially the newer ones. In today's video, I will be detailing 7 ways that investors get wrecked in the bear market. Before we poke that bear, tell me in the comments how you are doing in this bear market. Thank you for dropping in on the home of free financial content on YouTube. While you are here, please like and subscribe as you don't want to miss a single moment, and a huge thank you, of course, for that click. So what are those things that some investors do in a bear market to get wrecked? The first thing, and perhaps the most common way folks lose money in a bear market, is by panic selling. Watching your investments fall can absolutely result in a feeling of fear as your hard-earned investments get smaller and smaller. The natural reaction is to sell and to stop that bleeding. Unfortunately, in most cases, this is the exact wrong thing to do. Once you sell that asset at a deep red price, you turn an unrealized loss into an actual loss. In that simple action, you remove the option of letting that stock recover and gain back the value that the bear market stole from you. There are, of course, some situational times when selling is the right option, and we will talk about that in a few minutes. Our second way to get wrecked is to approach investing without a plan. It is always a good idea to have a general plan in place so that you have already decided how you're going to handle the market when a bear market comes around. This gives you some assurance that you're not going to fall prey to fear and other forms of emotional trading. A plan is simply the best way to deal with fear, uncertainty, or doubt, otherwise known as FUD. It is also good to have a plan in a bull market to help keep that fear of missing out, or FOMO, from causing you to invest in the least profitable way possible. To make money, it is very simple. Buy low and sell high. However, most people do the opposite, and they buy high and sell low. That is because they are falling victim to FOMO and FUD. Having that plan will grant you some immunity to those banana bread heads. Our next way to get wrecked is a failure to maintain a diversified portfolio. I cannot stress enough how important diversification is to a healthy portfolio. When you are over-diversified in a stock or sector, and either of those get hit really hard by the bear market, you are going to feel a lot of pain. It is the whole putting too many eggs in a single basket problem, and if you couple that with panic selling, holy banana bread, that is an investor ending move that can often end up with the person walking away from investing. Our fourth way to get wrecked is a failure to rebalance. Rebalancing is so important as it makes sure that you are still diversified and you are still within your risk tolerance. I did say earlier that there were situational times where selling a red stock is okay. For the terms of rebalancing, this is one of those situations. When you do sell red, make sure you are buying an equivalent or better red stock in the other sector. One easy way to do this is to compare the stock you are selling to the TSX or even the S&P 500. So if the stock you are thinking of selling is beating the markets, then maybe that is the wrong stock to sell. If there is another in your portfolio in that over-diversified sector that is doing worse. Generally, you want to buy a stock in a new sector doing as well or a little better than the one you are selling. The reason I say just a little better is that you want enough room for growth in that new stock when we get some recovery from the bear market as the stock that you're about to sell. Our next way to get wrecked is by becoming entirely focused on chasing yields. I know many of us love those high yield stocks, but they come with extra risk, and as such, I suspect most of you know not to only chase yields, but you also have some good solid chip stocks as well as a half decent amount of diversification. Personally, I will limit any high yield stock to roughly 5% of my overall portfolio. I can certainly, and I do have multiple high yields spread out within my diversification. In addition to those, I have my very solid, dependable blue chip investments that I use as more of a foundation of my portfolio. Some investors will, and I have seen this, they'll find that new stock that may offer a huge yield and then sink everything into it. You may be tickled pink with the returns, but if something goes wrong, we are back to having all of our eggs in a single basket, and that can lead to an investing disaster. Our sixth method to getting wrecked is by, well, refusing to sell the losers. Some stocks just fail, and in a bear market, that is a more likely time to see that happen. Sometimes a stock is simply a dud, and you have to sell it. You 100% want to do your due diligence on that stock, as the fundamentals will often help you big time identify these drowning stocks that want to pull you under with them. In some of these cases, you are not going to find a similar stock to save that investment, and it can absolutely suck to sell and realize a loss. But if the fundamentals are falling and the stock is unlikely to recover, you must do what you can to salvage your investment. If you are unsure, then don't just willy-nilly panic sell. You need to get help, and that leads us right into our top spot today. The best way to get wrecked is to never reach out for help when you are in over your head. You have heard me talk about due diligence before, and that is something that can save your money big time. There are a lot of educational content providers on YouTube, which is great, but there are licensed financial advisors out there that can also give you quite a bit of assistance. If you don't know what to do and your money is on the line, talking to a financial advisor and making sure that you are not about to do something that is going to get you wrecked is a good plan. Now, hopefully, many of you are not doing any of the 7 things that we just discussed, but I will admit that from time to time, I have even been guilty of at least one of these ways to get wrecked. I usually recognize it and fix it as soon as I see it. As always, just remember, investing is dynamic. It will always be changing, and you need to change along with it. It does not have to end here. Check out my video on Brookfield Asset Management that I will link on the left. Otherwise, check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.